when the department comes in to audit you, they have a presumption that all tangible personal property is taxable unless you prove otherwise. So you're going to give them a list of all your purchases, and then they're going to tell you, well, either show me that you paid sales tax on that purchase or prove to me that it's an exempt purchase. Services are the exact opposite. They are presumed to be not taxable unless specifically enumerated in the statute. And then people commonly ask us, well, how will I owe use tax? And you know, obviously there's an infinite number of ways that it can arise, but we're going to go through some of the common ways. The most common is when you purchase from a non-Ohio vendor that does not collect tax. And that vendor is not going to have an obligation to collect sales tax unless it has a physical presence in Ohio. So, you know, obviously the most common situation is when you order something from Amazon or on eBay, anything over the internet, they're likely not collecting tax on that purchase. So the consumer would owe use tax then on their use, consumption, or storage in Ohio. The second example that we see a lot is when a consumer gives their vendor a blanket exemption certificate, but then they make both taxable and exempt purchases from that vendor. Since the vendor has the certificate, they're not going to charge sales tax on any of the purchases, but the consumer is still required to report and pay use tax on the non-exempt purchases that they make from the vendor. Another common situation that we see is when a company will withdraw inventory that they make and use it for demonstrations or advertising or any other taxable use other than reselling it to a customer. And the same thing goes for sample or prizes that are given away. So if you take to a potential customer and you give them 100 widgets to sample to try to induce them to buy your product, you should be paying use tax on the value of those widgets. And then the last issue, which is a non-issue after January 1st, 2010, is when you purchase property in a lower rate county and then you take it into Cuyahoga County, for example, which has the highest rate in the state, and use the property in Cuyahoga County, you would owe the incremental rate in between or between what the sales tax that you paid and the use tax of the higher rate county.
Okay, so let's summarize that again in terms of the fundamental rules with respect to use tax, parallel sales tax, and that is that there's two core presumptions, and if it's tangible personal property, and I'll talk about that because sometimes that's the issue. If it's tangible personal property that's being acquired, the presumption is that it's taxable unless you can fit within a specific exemption from tax. And there's many, many, many pages and pages of exemptions, and some have many branches to the exemptions. But the state works with the presumption, and when they audit you, that all tangible personal property you purchased is taxable, and it's your burden to prove that it's not. With respect to services, it's the opposite. As Rich said, only specified services are taxable. And this is always so fact-intensive, very fact-intensive. There may be facts that are relevant that you're not aware of, or that you may not think they're relevant, that may need to be brought to light. And there may be facts that you can control in the future as to planning that you might do to take advantage of some exemptions. And so what I'm going to do for the next few minutes is just whet your appetite as to some of the core exemptions that you should be thinking about. And the first one is the resale exemption. And the resale exemption is very, very broad. It's any time you resell something in the same form that you purchased it. And what you got to keep in mind is that a sale is defined very broadly to include any transfer of title or possession of the property in exchange for consideration. Any form of consideration. It doesn't have to be monetary consideration. And so Rich correctly brought up that a common way that use tax can arise is if you pull inventory out and you give it away. Clearly, if you give it away and you expect nothing in return, you got to pay use tax on it, as Rich said. But what happens if you're giving it to somebody in conjunction with a larger purchase? You're giving them, they purchased 100 widgets from you, but you're going to throw in another 10 because they bought those 100 widgets. Well, that's not a giveaway. That's not truly given it to them, because the consideration you receive for the 100 widgets pertains to the other 10 as well. Or suppose you're working with a sales rep, and the sales rep buys your goods from you, but the sales rep also says, you got to give me some goods to give to my customers, and you give those to the sales rep. Well, that would also be a sale to that sales rep, because you're expecting something in return from that sales rep. You're expecting that sales rep to act on your behalf and to promote your product and so forth. And so you would not necessarily have to pay use tax on those that are given to that sales rep that buys your product in the future. It's conditioned upon that sales rep agreeing to make purchases in the future. That's why you're giving it to them, to that sales rep. So just to keep in mind, very, very broad exemption. We also have the manufacturing exemption. And, oftentimes businesses get caught up as to what's the scope of the manufacturing exemption. Just in a nutshell, your focus should be on identifying, in these next two slides, highlight this, the beginning of your manufacturing process and the end of your manufacturing process. Beginning of your process is when when your raw materials are committed. Essentially, when material handling from storage has ceased, or if earlier there's some affirmative act with respect to those raw materials. Your process ends as soon as your product is complete, and that's the next slide. And once you identify those two parameters, the reality is that if the property at issue is used within those two parameters and is touching the product or is one step removed, it's likely going to be exempt from tax. And that's probably a good way to think of the manufacturing exemption. Those two parameters, and if the property is used within there, there's some exceptions, but that are actually pro-taxpayer, pro-business, but that's the general gist of it. Then we have the packaging exemption, which I consider to be the most underutilized exemption. Packaging exemption is available for those that you have to have a certain status, the most common of which is you have to be a retailer or a manufacturer. If you're just a wholesaler, then you're not entitled to the packaging exemption. And sometimes that's the issue. Are you a manufacturer? You may be involved in a process that the state doesn't consider to be a manufacturing process, but is. That may come up in the scrap recycling area and so forth. But you need that status to get the packaging exemption, or be a retailer for the most part. And there's two categories of property that apply that are exempt. Packaging material, which is anything that restrains movement in more than one plane of direction, restrains movement of the product, that is, or packaging equipment. And packaging material can include even the shrink wrap and the pallets that hold boxes of your product. Those are also packaging material, which would be exempt from tax. Can be very significant dollars as long as they're working together to restrain movement of that product in those boxes. And the relevant packaging equipment as well would be exempt, the palletizer, the shrink wrapper, and so forth. And even there's a big line of cases that extend the packaging exemption to property that's even an integral part of your packaging process.
And I'm just going to pause you guys right here. We have two questions from the audience. One, will the presentation be made available through PDF for the audience?
Yes, we're going to post it on our blog, which is www.ohiostatetaxblog.com. We'll post that later today.
Okay, and we also have another question. How can clients' medical records be considered TPP? The records belong to the client, and they are the end users. The client ultimately pays for the records. Medical records should not be considered TPP.
Well, I think we need to have that question clarified. This comes up in the context of our practice where perhaps you're paying, a law firm might be paying somebody to index records and so forth, medical records, and then a service like that. And so I think we need to know more information. But if a medical provider is just providing compiling records for the patient, and then if the provider sounds like it may sell to the patient, if the patient wants the records, I wouldn't think that's tangible personal property either. I'm not sure what context the question is being asked.
Yeah, when it's given to the patient, it sounds like it would be incidental to a professional or personal service,
right,
which would not be taxable.
It's a convenient way to communicate the personal or professional efforts of the medical provider, and so as Rich said, it would be incidental. But there are contexts where that type of property would be taxable, and I was talking to an attorney a few weeks ago that said that they're being audited because when they try to acquire records from various sources and they have them copied, that would be a taxable service, copying the records and so forth. And sometimes you get into whether it's an electronic information service, the retrieval of information online could be a taxable service because that's specifically enumerated as a taxable service in the Ohio Revised Code. Okay. So I was just talking about the packaging exemption. Just to keep in mind, very, very broad exemption. There's an exemption for qualified research and development equipment. And essentially, that exemption is very broad also. It's outside of the manufacturing exemption. It's available for tangible personal property that the cost of which is capitalized. So it doesn't have to be equipment. That's why our slide says, you'll see here in a minute, that qualified research and development equipment doesn't necessarily have to be equipment. It can be canned software that was acquired that was used for R&D purposes. As long as you didn't expense it, if you capitalized it, it would be exempt under this exemption.